Imagine you spent years building your business, and now it's time to transition, and you want to do something better, bigger, and continue to grow your career or retire or move on, and you want to find somebody to take over your business and to pass that legacy on. Today, I have a special guest. I'm joined with Scott, who's a business broker, and he walks people through this process to make this transition as smooth as possible. Scott, please
Yeah,
introduce
my name
yourself.
is Scott Hite. I've been in Portland, Oregon since 2017, and I've been a business broker. And my job is to represent sellers selling their small businesses, mostly Main Street business types. And I've sold over 100 and over 10 years of practice. Before the 7 years in Portland here, I spent 5 years doing the exact same thing in Louisville, Kentucky. So I've sold a lot of businesses, seen a lot of businesses, have a lot of great stories. But yeah, the process is something that most sellers only do once or twice, maybe three times in a lifetime. So very rarely does an owner know how to do this process. So that's part of my process is to educate them. So yeah, I think I'm a credible person to talk to when it comes to selling a business, a small business like a lot of the businesses here in Portland, Oregon.
Absolutely, and there's a huge need, especially as the boomers are wanting to retire and pass on their baby. Walk me through just the basics of like when somebody wants to start selling and they start thinking about it, and they come to you, the
Yeah,
process.
I represent sellers. So 99% of the time, I represent sellers. I'm their agent and I have a fiduciary responsibility for them. However, I'm also dealing with the very buyers that will be purchasing their business. So even though I'm not representing them, I'm actually dealing with them. So I do see both sides. Very rarely does a buyer understand the perspective of the seller, and very rarely does a seller understand the perspective of the buyer. They're totally two different things. But it does happen, and that makes it a lot easier for me. That being said, I'm exactly what you consider me. I'm the broker. I'm the one that is in the middle, and I'm trying to play a matchmaking game here. When I evaluate a business, the first thing I do, I usually get a call from the seller who says, Scott, I'm thinking about selling my business. Can you come by? Or can I tell you a little bit more about it? Something like that. It usually comes in either an email or a phone call, probably a phone call. And then I do a visit if the business is something that I can visit, or I schedule a phone call with the seller and then I ask them to describe the business. And then I'm taking a broader look when I'm getting this description or I'm seeing it. I'm trying to get the vibe of the business if I'm there, or if I'm talking to the owner, I'm probing, trying to find out exactly the details of what he or she does. At that point, at some point, I'm going to be asking for their financials because that's going to be the first look that a buyer would have. So I get the financials. It's going to involve pretty simply a P&L for the last couple of years, a balance sheet for the couple of years, and a list of assets. That's it. That's all I need. And then at that point, I'm also always developing a SWOT analysis in my mind. If you're not familiar with a SWOT analysis, it's strengths, weaknesses, opportunities, and threats. That's going to allow me to establish a valuation for the business. So that's the process that I have when I initiate the process of looking at a business to sell.
Yeah, that's a good process. Thanks for summarizing that. I'm sure it's
Yes.
a lot more complicated than that, but that's just the bare bones. So that's important. So the second question would be setting a competitive value and valuation. So within your SWOT analysis, you talked about that's helping you to set this valuation. And I know valuation is so complicated and it's easy to go off on
Mhm.
different tangents, but is there a way to simplify?
I can talk a little bit about the valuation process for a small business. The first thing I would have to say is that the businesses that I deal with are what we call Main Street businesses. And I categorize them for myself as businesses as small as a food truck or a coffee shop and as large as $2.5 to $3 million selling business. That's a category or a sweet spot for me, the type of businesses that I deal with. They're the hardest ones to evaluate. They really are. And most brokers do not like to do these smaller businesses because it's just as easy to sell, in their mind, larger businesses that involve private equity groups and people with a lot of money that can evaluate them a lot easier than these smaller businesses. But that is my wheelhouse, and that's what I specialize in. When you talk about valuations, there's typically accountants usually use three different types of valuations to get a process started. One's called an asset valuation, one's called a liquidation value, and one's called income capitalization when they're trying to evaluate a businesses. I avoid those. Are not what we use at the Main Street level, because it's not a good calculation for what a fair market value would be in an open market in Portland, Oregon, of what that specific type of business would be. So I prefer what we call an income multiple approach, and that involves bringing a multiple of how much money an owner can earn for themselves personally. So it's complicated. It involves a lot of that SWOT analysis as far as establishing a multiple, but all those factors come into play when I evaluate a business. I've
Perfect.
got great
Um,
stories with that are all over the board. Like I'm dealing with one now that involves the P&Ls do not really match what the cash flow is, and so it really comes into play when that business goes to market. So every little detail matters, especially for these smaller businesses, and it gets tough sometimes because there's it's not objective; it's a very subjective process. And usually, not any one of these parties that are involved is an accountant, right? They don't deal with this every day. A lot of them avoid any kind of numbers and financials because they don't like to do it. They leave that for people that are more that are in that professional field smartly. So when you're discussing those things, they all have they bring in their own biases and perspectives.
I think that sellers think that their business maybe is valued here. A buyer thinks that it's valued down here, and there's that gap. And so trying to find reasonableness, and people's feelings do get hurt because it's their baby if they're selling it, and probably a lot of emotions that you deal with when people are like, let's should be this, and people were just giving me this low offer. I'm sure that can be a challenge
Absolutely,
too.
and it's all over the board. Some sellers undervalue their business; they have no idea, and they walk into
Mm.
it. So it's not necessarily that they overvalue it, which happens more often than not. Sometimes they undervalue it. And on the buyer side, again, it's very rare that a person goes and buys a business in their lifetime. Sometimes we have serial entrepreneurs that are doing this. They have a lot of knowledge and experience. They're very rare around here that I'm seeing that. I'm seeing folks that have done this for the first time, maybe a second time. And the valuation process is, again, it's very subjective, trying to get through those minefields and try to get them to make offers and to consider them reasonably is a skill. It's a skill that I have developed over all these years, but I'm still not 100% great at it. It's just me putting two people in a room and letting them negotiate back and forth with maybe very polar opposite viewpoints. But if both are motivated parties, they usually come to a consensus and it works out.
So my next question is dealing with marketing and finding and attracting the right buyer. Like, how do you market? How do you attract and find buyers for the
It's a
sellers?
simple process for me, and it's a good question because think about if you were to want to go buy a business, where would you look? And the thing that complicates that is that we can't just put a business on an open market like residential realtors and commercial realtors because we have to keep things confidential. And what I mean by that is I can't just put a for sale sign on a storefront. If you did that, you would scare away customers and you might scare their employees. They might quit. So all those variables into play. So we have to be super confidential. So marketing's tough. So what I end up doing is creating a ad. Maybe it's a coffee shop. So if it's a coffee shop, I would say, hey, Southeast Portland coffee shop that does $500,000 in gross sales. And I wouldn't give much more information than that because I don't want them to figure out who it is, or it's going to be out there and customers could bail and rumors could circulate and employees could quit. So I vet the people that come in and reply to these ads, and I vet them for seriousness and financial ability. The platform that I use that's the best is called Biz Buy Sell. So if you want to buy a business or if you want to sell a business, most people use that one unique platform for small businesses, bizbuysell.com. And that's where you would place an ad. And you'll notice when you're looking there, most of the ads on there are just like mine, very generic. They don't tell exactly who they are, and they give very broad information, requiring the buyer to call in or email and sign an NDA saying they will not, the things that they hear, including the fact that it's for sale and all the financials they're about to receive on the business. So marketing is unique. It's very different from any other type of real estate, but it's pretty much the only way that we know of, besides just general referrals, that we have to place it on an open market.
Yeah, and the NDA, the non-disclosure agreements, that's really important. The confidentiality, that's so
It's super
important.
important for
Absolutely.
financials because we're going to probably be sharing tax returns with sensitive information. And of course, the fact that they're for sale. A lot of businesses do not want anyone to know that they're for sale, especially because it's inviting a disaster. Yeah, that NDA is important. And by the way, I didn't disclose this initially, but I am a licensed attorney. And I do disclose that to anybody that I talk to just to make sure that they're aware. It gives me credibility when I give them an NDA, and NDAs are hard to enforce sometimes. And the fact that I'm an attorney helps the sellers protect that information because I'm very serious about it when I collect that information.
My next question is dealing with SBA loans in the selling process. So often SBA loans can be an issue, sometimes not. And I'd just love to hear your thoughts
So
on
most of my
SBA loans.
businesses I will probably the minimum amount that I would actually consider selling is probably 50 to $75,000 business. That's food cart range, right? So that's what I'm thinking about there. And then on the high end, it's going to be about $2.5 million. SBAs, they do not like to loan less than $200,000. They will in certain circumstances, but that eliminates a lot of the businesses that I have for sale as far as even qualifying for an SBA loan. Their sweet spot's going to be over $200,000 all the way up until 5 million. So that's an SBA type loan that they prefer. So that's part of this process, which means that 75% of all the businesses that I sell involves an owner's carry, which means that the owners is actually signing a promissory note with the buyer to some percentage of the sale. So a lot of people do not know that. A lot of people think that they can just go to the bank and get a loan for these small businesses, and they find out real quickly that's not the case. Even with the SBA, because the SBA kind of snickers at loans that are less than $200,000. It better be special or they won't even mess with it. They're just not worth it for them. And remember, when you're dealing with an SBA type loan, it's an SBA 7A loan, is what it's called. You have a lender who's actually making the loan, and then you have the SBA who's actually guaranteeing the loan for the lender. So that process is built in. That's the preferred type loan of any bank or any lender for any kind of business loan. They just do not want to take the risk of a business. So if it's not going to be an owner carry situation for the buyer, the bank would only use the SBA 7A type loan to lend on. So I'm dealing with both of those types of buyers that use both of those tools to try to buy a business. With all the businesses that I've had, and again, that range is anywhere between 50,000 and over 2 million, 75% involve some kind of owner carry. So that's the easy way for me. If that happens, then that makes my world a lot easier. That means that the buyer is going to come in with a significant amount of cash. It could be anywhere from 20% down payment on the total purchase price to a lot more than that if it involves real estate and significant assets. Since I'm an attorney, I can write up that closing myself and actually close it all myself. That simplifies things for me. If it involves an SBA loan, then I pretty much can turn it over to a bank. But what that requires is a long process for them to get everything that they need and get it from start to closing. And sometimes that takes 90 days, 100 days. It's not the SBA's fault. It's not the lender's fault. It's just the process that's built in, and they require a lot of information, a lot of verification information, and it's very hard to get some of the information that they ask if you're a seller because they just don't have that hanging around in their business. They're too busy operating the business to have some of the things that they require. So that delays things. So it does become a little complicated. So 75% involve an owner carry, and then the rest are probably SBA loans. That's SBA loans or somebody's bringing in cash And that happens too. People just come in and they bring in cash, and that might be done from some kind of source that they have. They might sell some stock, or they might be using equity from their home or whatever, but they would just actually have cash at closing.
So with that owner carry, there's obviously pros and cons to
Yes,
that. And how often are the previous owners still involved in the business after the
almost,
sale?
I
Does
would
that make sense?
say 99% of all the small business deals that I do involve a closing that requires the current owner to provide some kind of transitional training. I've seen it anywhere between 1 week, like at a restaurant, that they would provide unpaid training to the new owner, to over a year. And sometimes I'll even have the new owner hire the old owner as a consultant or actually an employee in their business. So almost all of them have some kind of transitional training. It's required by the SBA in many instances, but I can't imagine anyone would buy a business without some kind of transitional help, even if it's just to do the normal due diligence of transitioning employees. Almost all of them have that. They have those issues involved.
That could be a big process right there, and I'm sure that there's a lot that goes into this that transition, making sure that everything's smooth because the buyer wants it to be making money, obviously, and you want it to continue to grow and make it even
I'll
better.
go one step further than that.
Yeah,
Most
that's
buyers expect to be getting cash flow on day one. We call that a turnkey business. And if they're buying a turnkey business, they want to be able to open the door on day one and start earning money in some way. And it doesn't work as simple as turning over the keys, right? So you got to, if you're a reasonable seller, you've got to assure the new buyer that on day one that you're going to be able to make that transition process as smooth as possible. So that always involves some kind of training.
definitely. And so there's definitely an advantage of buying a pre-existing business than building your own. There's infrastructure, sometimes there's employees and customers and goodwill with maybe websites and location and all this other stuff. That's there's a huge advantage of buying a business instead of just starting
In
from
my
scratch, even though you got
I'm
to take on
biased,
it. Go
so
ahead.
yeah, I definitely believe that.
Yeah.
But it doesn't take much math to, you just do some general math if you're considering both, and you'll find out that the cost of starting a business that might be your dream business is going to real quickly involve a lot more than if you were to buy an existing business as it stands and try to grow it and try to do better with it. It's just, you just do the simple math and you'll find that's the case. And there's a lot more to that too. There's a lot of more advantages to that as well. So in my mind, absolutely, that's the way to go.
Yes, for sure. Building those relationships. This transitions into the next question with vendors and customers and having strategy for that and taking over. So sometimes those relationships are tied to the key person that was leaving. And so sometimes there's those transitions. And so that's a benefit of having the owner stay on to make sure those relationships are maintained and transferred correctly. I'm assuming you've seen examples where things fall apart
Absolutely.
when a new owner
Yeah,
comes in.
I would say it's more than just a benefit. It actually has some kind of a measurable value. So when you're buying a business, you go to closing and you try to break down for tax purposes what percentage of what is what. There's going to be a percentage that's goodwill, and that goodwill includes those relationships that you're talking about. Everybody, and I hear cynical buyers come in and say, "Oh, that's just blue sky," or they'll have some cynical name for it. But goodwill's super important for a small business because that's really significant of what they're buying. The two most important things in my mind that a buyer buys with a small business that's established and in place is the sales, the pre-existing sales, and the sales that they're going to get as soon as they open the door. And second is that goodwill. And that includes a real broad array of things like their brand and those relationships that you're referring to. All that's in place on day one. Now, think about that. Weigh that against trying to start your own business from scratch and building that. How long does that take? It's going to take a long time. I don't care if it's even a year or 2 years, or in these cases that I'm selling, businesses that have been established for 5 and 10 years. It's almost priceless. It's hard to put a number on, but it's significant.
Right. And often, the majority of what a business is buying is the intangibles. That's not even on the financial statements. Accountants don't record. As an accountant, we don't record the most important thing that the business has, which is the
That's right.
goodwill, the people, right? The atmosphere and the culture. That how do we measure culture on the financial statements? We don't, but we measure it when we go to sell it. And the biggest asset that we have is the business itself. A lot of times people think from an accounting standpoint or from clients, hey, I'm making this amount of money each year, but they don't think about selling the business is the business that they're in. And because they're just making money, it's their baby. They've started it or they bought it and they're trying to grow. They're living off of it instead of thinking about the exit strategy and how do we continue to increase the multiple? How do we increase the value of that business so when we do sell it, we can get the most out of it? So this question goes to you, Scott, is like, how do people build the value in their business so when they think about exiting and selling, they can actually have more
Oh,
value?
you're so right with that. I wish I've got so many examples. It goes to when residential real estate, when realtors talk about showing a house and staging a house, that sort of thing. Businesses are a lot different from that, but it's a lot different, but it's similar in many respects. One's just those intangibles you're talking about. You've got to be able to show that, or it might just be evident walking into the business. A good example would be walking into a coffee shop. We've got so many coffee shops here in Portland. You walk into some, and you can just see the activity bustling, and just you can just see that walking in the door, you can see that the coffee shop is successful. You can see that the people are there for a reason. There's the vibe is just good. Everything's in place and it's clean and all the things that you love about a coffee shop. And then if you walk into one that's not really well run, you can see that too as soon as you walk in the door. So many businesses neglect that vibe that I'm talking about, which goes right to the intangibles. So the advice I would have for anybody that's thinking about selling a business, first of all, get out in front of this. Get out in front of it as far in advance as you can and try to start thinking about those things, making sure that you get everything, all your ducks in a row before you put it on the market. Every one of those details matter. And especially with the financials, that's one of the last things that a true owner to do is to make sure their financials are accurate and in place. And then they get asked right at the time that they sell it, and they're a mess. And then I'm spending most of my time trying to clean that up with a buyer who's looking at it. So all these things are real easy to get out in front of. So they're starting to think of about it, when an owner starts to think about an exit strategy, that's when you need to bring a broker in. There's no fees for it. There's no cost, and let them do a valuation, and they can give you some advice like that.
Absolutely. Yeah, the further out. And this is my passion is helping people because as I do tax planning, not only for now in retirement and succession planning and legacy planning, selling the business, because we deduct things that are legally, ethically, morally, and above board, but we want to classify those things. Could be the Augusta rule where we're renting the house out to ourselves, to the business up to 14 days, and or we're home office or other things that we've done, trips and whatever. We don't want to be penalized for those expenses, and we want to make sure that those are categorized correctly, that we've documented legally, ethically, morally, so in an audit or any type of due diligence. But then when we get to selling and the buyer looks at those financials, we can clearly allocate, hey, these are tax deductible items that are directly related to the owner and that would not be passed on to the new buyer. And so we want to clearly define what those things are, categorize it, and make it easy for the buyer to see, hey, these are tax planning techniques and strategies that are legally, ethically, morally above board, but they're not going to be expenses. And so the actual income and the net profit would be higher because the new buyer may not have those particular expenses. And I like to try to transition and track those so a buyer could see that easily and be like, oh, that makes sense. And that's why we have a higher multiple when we
Yeah.
go to sell, and people are making more money, but we're still tax planning for now, retirement upon death and
And we're
succession
both
planning.
right. We need to get out way out in front of it for those people that we're representing. But I'm going to take the buyers or the owners as a devil's advocate here. And why they don't do that is because I own my own business as a business brokerage owner. But that stuff makes my head hurt. And all the things that I'm doing today, that's the last thing I want to do. So you know how that gets. That's why we procrastinate. That's why owners procrastinate to me. And I get that. But the smart ones, the savvy ones, they're way out in front of this and they know what you're talking about. They know it's true and hopefully they do. So anybody out there that has a business that's thinking about this, now's the time to call. Get out in front of it. That being said, almost every single one that I talk to, it's too late. They didn't get out in front and now we're playing catch up. They're losing value and they have no idea. They do not know what a multiple is at this point, but they are losing that value.
That's the nail that I'm trying to hit with this hammer. And that's why I want to do these podcasts, because I want to communicate clearly tax planning now, tax planning for later on, and saying, let's do this planning, because so many people are focused upon making money now, but they're missing out on the big sale. They're missing out on a multiplier that could be continue to increase if we do things correctly. We want to focus upon now, but also put attention to in the future. So if we can carve out 1 hour a month or 3 hours a month, and just here's a dedicated thing that we can do 1 or 3 things each month, and the next 24 months or 5 years or whatever, we've got this huge list of things that have increased our value of the company, that we've put more money in our pockets, that we've done tax planning now, retirement upon death, because taxes are the biggest expense that we have over a lifetime. And especially a sale where you could be selling for millions of dollars, and that could be a big tax hit. You're going to jump up to the highest tax bracket. Is there things that we could be doing to plan for that, to reduce that? That stuff takes time. I've got so many stories of people. I was going to save this guy $600,000 or more on this sale, and then we went to the attorney, and the attorney's, oh, that's too risky. We can't do that. And he went through the sale 9 months later. He's, oh boy, can I get some of that $600,000 back? No, it's too late. Like, you already went through the sale. It's already gone, right? You overpaid your taxes. There's nothing we can do. And it just breaks my heart because the attorney killed the deal, and nothing against attorneys, but it's just, sometimes it's too late. And what you mentioned several times, we got to start early. And that's why communicating, getting the message out, let's start now, let's start early and start planning that, because it can take 5 years or it could take more. And let's continue to look at the big multiplier of selling the business and not only making money now, but also making a lot of money when we
I'll
sell.
give you another example. I have a situation right now as I speak. I have a listing where the person gave me a P&L that shows cash flow a lot less than what they're actually cash flowing. And the reason they're showing this P&L is because they're minimizing taxes with all these deductions. And their total focus is to pay less taxes, the least amount of taxes as possible. Some of these write-offs and deductions, I'm sure they're all legal, but some of them are a little gray area. But what if their focus, instead of tax deductions, was on selling the business? Their P&L would look a lot different. And maybe if they got out in front of it for next year, if they're going to sell it, next year's P&L would look a lot different if they're trying to sell the business. There's a good example that falls right into your realm right there. But right now, I'm trying to explain to the folks that are looking at this business why their P&L shows such a small cash flow as far as net profit and everything else, and it's hidden in all these ad box. And so it's very difficult for me to explain that to them when all they had to do was have a P&L that kind of made more sense to these folks that are looking at their business.
So know your audience, right? It's getting back to English 101, right? Know your audience, who you're writing the paper for, and just make sure that, obviously, we want to write this paper, the tax return, for the IRS to make it look pretty, right? Put lipstick and a dress on a pig, it's still a pig. We want to doll it up, but also who's our audience for the buyer, and planning that stuff ahead. We might have to reformat the P&L and the financial statements, maybe even start another company or something to like clean things up, because I see a lot of messes. A lot of people have things in there they shouldn't have things, and it's going to hurt them, and try to explain all this and spend more time, and the buyer is going to be like, this is a mess, I don't trust this. Versus if it's clean and organized and it's, hey, this is really makes sense, this is all business, this is the reimbursements for the owner, and so we can really separate that out, still have it legal, ethical, morally, because we've deducted it. So in an IRS audit, because again, my experience is working for the Internal Revenue Service. I spent almost 6 years there and gave them the finger and walked away and started annual tax. And now I'm helping people to plan, prepare, and to avoid those due diligence oopses and those 5 words. This could have been avoided, right? We want to avoid those most expensive words.
So it is so important to make sure that's a good impression. And when they see something that's not good, then they just, in their case, they just go away. They don't even tell me they're going away. I just don't hear from them again. See you later. So that could have been a good buyer.
Transparency is key, but just, yeah, putting things in the right order. I think there's a lot of people doing it themselves, or accountants, they just aren't thinking about exit planning. They're not thinking about the buyer, and they're just thinking about whatever, and it's outdated, and we need to revamp this. And that's where having a good accountant, that's why I'm doing these podcasts, because I want to help people to increase their expenses now, legally, ethically, but then also have a good multiplier and not let those expenses that they're doing for tax planning hurt them in a sell, and that people don't run away, but instead, hey, that guy's really smart. Like, he's got a good tax planner right there, because it's real clear of how this is business and this is reimbursements, and we got all the documentation and in that packet. So, yep, here's all the reimbursement policies, and here's all the documents that we would need in an IRS audit anyways. And if we give that to the buyer, the potential buyer with the NDA, then I think the buyer would be like, wow, this guy's great. He's got his ducks in a row, and that builds trustworthiness, right? A rising tide floats all ships. And so if we have good financials and good documentation, and that builds so much credibility, and that could also increase that multiplier.
It definitely increases or decreases. If I see just the opposite of that, that multiplier goes down right away. And that goes to the thing I mentioned earlier, as far how does it show when a residential house is being sold, and the realtor goes, your house shows well, or it doesn't show well. That's exactly what I'm talking about when I see those financials. If an owner gives me some sloppy P&Ls that I cannot determine anything, I'm just going, the multiplier is what I'm thinking about. I said, I can't get you a multiple of higher than 1.5 or 2 at the most, whereas the business could be doing really well. They could go up to 3, maybe even further. And I just can't. The P&Ls and the financials are such a mess that it just will not show well.
That makes a lot of sense. This has been a great episode. For people who want to get a hold of you, how do people get a hold of you if they're thinking about selling, they have questions for you? What's the best way to?
My brokerage name is Businesses for Sale in Portland. So that's my name. And my email address is scott.hite at businessesforsaleinportland.com. So all that. But if you look online, you'll find it. So go to Google and Google Businesses for Sale in Portland, and you'll find me. I'm on the website, and you can just hit me with an email. What a lot of sellers and buyers don't understand, I work on commission. The standard commission in my industry is 10%, which seems high for a lot of people, but that's standard, and it's been that way for a long time. It's just harder to sell small businesses, and there's no other fees. So if you're getting a valuation and you're calling a broker for it, typically that's going to be a free service. Well, there's no reason at all why you wouldn't call a couple of brokers to come by and give a free valuation and just see where you stand. And they're going to get a lot of advice for that little inexpensive, non-expense service that they provide.
Great. This has been wonderful. Thank you, Scott, for coming on, and I appreciate all your advice, and this is
Thank you. I'd love to come on.